You and your neighbor. Same age. Same city. Same insurance company. Yet somehow, you pay 40% more. No accident. No bad luck. And definitely not random. Behind your premium is a silent calculation engine that decides, within seconds, how risky you are as a human being. And once you see how it works, you will never look at insurance the same way again. Insurance companies do not sell protection. They sell probability. Every premium you pay is based on one single question. How likely is this person to cost us money? That is it. Not fairness. Not morality. Not even health. Just math. And that math is built on 4 invisible layers that stack on top of each other. Miss even one and your premium explodes. The first thing insurers evaluate is who you are on paper. Your age, your gender, your marital status, your location. Why? Because historical data does not lie. Statistically, younger people take more risks. Certain age brackets file more claims. Some regions cost insurers more to operate in. Even your zip code matters. 2 streets apart can mean different hospital costs, different fraud rates, different claim frequencies. You might be healthy, but your demographic twin was not, and you inherit that risk score. Now comes the part most people think decides premiums. Medical history. But here is the twist. Insurance companies do not just look at what you have. They look at what people like you usually get next. Blood pressure slightly high. BMI a bit elevated. Family history flagged. Each of these is not a diagnosis. It is a trajectory marker. You are not being priced for today. You are being priced for 5 years from now. This is where it gets uncomfortable. Insurance companies care deeply about how you behave, not just who you are. They analyze smoking and drinking patterns, job type and work stress, driving habits, yes, even indirectly, claim behavior in the past. If you have filed claims before, even small ones, you are statistically more likely to file again. Not because you are dishonest, but because human behavior repeats. And insurers price habits more aggressively than illnesses. Here is what most people never realize. Your premium is not calculated in isolation. You are placed into a risk pool, a giant bucket of people who look statistically similar to you. If that pool performs badly, you pay more, even if you never claim a rupee. This is why premiums rise even when you have done everything right. You are subsidizing the behavior of the group. Insurance is socialized risk disguised as individual pricing. Ever notice how 2 insurers can give wildly different premiums for the same person? That is because each company has different claim data, different risk appetite, different profit targets. One company might avoid high-risk profiles entirely. Another might specialize in them and price accordingly. So the best insurer is not universal. It is relative to your risk profile. Modern insurance pricing is not done by humans. It is done by models trained on millions of lives. These algorithms do not ask, is this person healthy? They ask, how expensive is someone like this over time? And the model adjusts your premium in real time based on market trends, medical inflation, claim frequency spikes. That is why premiums rise quietly. No announcement. No negotiation. Just an updated probability. You cannot game the system, but you can align with it. The biggest premium reducers over time are fewer small claims, stable lifestyle signals, choosing insurers aligned with your profile, and locking in policies early. Insurance rewards predictability more than perfection. Your insurance premium is not a judgment. It is a forecast. A financial weather report based on millions of lives before you. Understand the model And suddenly, the price makes sense. Ignore it, and you will always feel like the system is unfair. Because once you see how the machine thinks, you stop fighting it, and you start using it.